Hello, welcome to TresVista Talk. I'm Abhilash Jayakumar, co-founder and co-CEO of TresVista. Today, I have the pleasure of being accompanied by some of the leading experts in the secondary market. I have with me Lisa Sun from BlackRock, Yann Robard from Dawson Partners, Nigel Don from Evercore, and Kevin Dunwoodie from Pantheon. Thank you so much for joining me today. So maybe we'll dive right into it, and I'll maybe start the conversation with talking about the current growth of the market. And it seems every year we talk about hitting all-time highs. Last year we had 160 billion in transaction value, and the first half of this year has already crossed 100 billion, and we're on pace for another record year. Lisa, what do you think is driving the sustained growth, and what are the buyers' motivations and the strategies evolving in 2025?
Yeah, sounds good. Well, thanks for having me. And I agree. Every year we're seeing record growth. I watched the last few years, and it's been record growth every single year. So you mentioned it. Last year, 160 billion in secondary volume. When I think about the reason why there's been tremendous growth, it really does start with the $12 trillion of unrealized value. And that to me is the foundation. That's the base from which secondary transactions occur. So when you think about what increases that base, it's new fundraise. And so there's on average about $1 trillion of new private money coming into private markets across private equity, credit, real estate, and infrastructure. So, and most specifically, distributions that leaves private markets into public markets will reduce that NAV. And then you have the secondary volume, which on average, it's been about kind of 1 to 2% of that 12 trillion of foundation. And so year to date, actually through Q3, the numbers that I've seen is 165 billion. And so that has already surpassed 2024. Historically, Q4 is actually seasonally at the highest quarter by volume. And so if when you look at things that are in our pipeline, I do think we can actually reach $250 billion this year. That would be another record. It implies a 40 to 50% increase in volume from last year. And again, what is actually remarkable that even if it does reach 250, which I think is a bit of a bold prediction, but if it does reach 250, that is still only 2% of the turnover of the 12 trillion of base. So that has been one of the sustained long-term drivers of growth for the secondaries market. And so as the turnover number rises and as the foundation itself rises, that has been one of the drivers. Another data point that I also think is quite revealing is that within private equity, there are roughly 29,000 portfolio companies. And then nearly 15,000 of that, so almost half, has been held for more than 5 years. And then when you look at exits, on average, the market can take about 2,000 exits per year. And so when you take the 15,000 divided by the 2,000, that in of itself implies it will take 7 to 8 years just to work through the overhang or the backlog of companies that are 5 years old. And every single year, companies are getting older and older. So in other words, it would take nearly a decade to just clear the current backlog. And so when you then think about the foundation, the 12 trillion plus the backlog, these are all, in my mind, the sort of the powerful tailwinds for secondaries, as both GPs and LPs are looking for this alternative liquidity path.
Obviously, the fundamental growth of the underlying market is going to drive growth, but increasing involvement in secondaries is also a dynamic that's going to increase the volume. And you talked about, and I saw some eyes pop when you said the 250 billion number. I know people are optimistic about how this market will continue to grow. It's a question of when and specifically how. In years past, when we've had this conversation, we've talked about the lack of talent in the secondaries market. It's as big as it's grown. It's still fairly niche. The community of professionals who are able to actually understand it and do it intelligently is still small. Yet there is a growing influx of capital from new entrants. And Nigel, you sit in the middle of this ecosystem. How have new entrants impacted the secondary market dynamics, if they have?
Yeah, happy to take that one. In terms of the dynamics, right? I look at LP side, a few things, right? I think one is definitely like the new entrants in terms of evergreen capital, 40 Act funds, bring in more capital in. We think about $25 billion of capital is raised from these vehicles this year for these vehicles that goes into secondaries. So that was capital that wasn't necessarily there a few years ago. In addition to that, we think LP co-investors in LP deals are a meaningful part of the market now, which not necessarily there a few years ago. So what is all this doing in terms of behavior? Firstly, on the LP side, right? One is, I think, firstly, dynamics in terms of preemptive bids, buyers having to react quickly. It is a more competitive environment, notwithstanding the, deal flow available, just because there's more, competitors coming in. We also see, drilling down one level, recent vintage funds also, there's more demand because 40 Act funds tend to prefer high quality. They want to buy growth. They want to buy NAV that's likely to go up. So we see that a particularly competitive part of the market. On the GP side, the changes there, I mean, we would see 20 lead investors now, funds that could lead a GP-driven transaction, a continuation fund, for example, whereas 4 or 5 years ago, it would have probably been 4, 5, 6, a handful of groups. It's a significant change. With that, we feel the entry price in the continuation vehicle market to be a lead investor in terms of size of check has gone up. So many groups, traditional secondary groups, new entrants, are looking to write $500 million or more into a single company to be able to lead a transaction. And the dynamics there is that middle market transactions, harder transactions, tend to be more competitive, tend to move quickly, and tend to be, the focus of this market generally. And maybe the last thing that I would say there is dynamics on the secondary GP-driven part is that the rules of the game are changing in terms of how much a GP should roll over. These last couple of years, I think it's been 100%. There's downward pressure on that. In some ways, upward pressure in terms of GP economics for the most attractive part of the market, and the like. So we see, pressure there, and also pricing pressure in that a market that has been traditionally anchored around GP NAV, around 100% of NAV, there's more flexibility we find with new entrants in terms of how they price these transactions. So in terms of the dynamics of the market, both on the LP and the GP side, those are the elements that we see coming into play.
And look, I mean, I would love to just take a step back here, just the history of the secondary market, where we're at, so where we've been, where are we at, where are we going. And so I always like to describe the secondary market. We have entered our third chapter of the secondary market. The first chapter was 2001 to 2011. That was a decade of institutionalization for this marketplace. The pioneers were established, track records matured, institutions took notice, and the secondary market went from $5 billion to $25 billion. And then in 2011, we entered what I call the decade of innovation. We went from essentially just being an LP secondary market to having, single asset continuation funds, multi-asset continuation funds, pref, NAV lending, credit secondaries, real estate secondaries, infrastructure secondaries, GP stakes. I think the lines are blurring between the two. And the secondary market went from 25 billion to 125 billion, another 5 times increase. And then in 21, we entered the decade of capitalization for the secondary market. It's exactly what you're talking about at the end of the day, is that, there's more new entrants coming into the market. And I think Nigel did a great job of describing how it's shifting the dynamic. But this is good for the secondary market. The one thing that's constraining the secondary market, the reason why Lisa didn't say 300 billion versus 250 billion is that because there's not enough capital still in the secondary market, and there's not enough resources, which is what you mentioned at the end of the day. That's what the constraining factor of this industry is. If you're talking about 1% to 2% of private equity churning in any one year, there is a huge amount of growth left in the secondary market, and we're just getting started. We're in the first innings of this, despite us being in this for 25 years and seeing exponential growth in all of this. I mean, the thing that kills my soul is when I hear a headline or I read a headline out there that says record fundraising year for the secondary market. Factually correct, and also not enough to keep up with the amount that's being deployed in the secondary market. So in my view, dry powder is shrinking, not growing. So if you've got 40 Act funds coming in, if you've got new entrants on the GP led, that's only enabling this market to continue to grow and serve what its purpose is, which is to inject liquidity in an otherwise illiquid asset class. And if it's done with the right process, the right structure, the right mindset, we're just getting started. I really truly believe that we shouldn't be calling this asset class alternatives anymore. I think it should be called privates. I think there's public equity and there's private equity. There's a reason why public markets have gone from 8,000 companies down to 4,000 companies. There's a reason why private markets have gone from 5 trillion in 2016 to, I think it's closer to 15 trillion right now. It tripled over the last decade. It's because the private equity has its place in the capital markets, and the secondary market in particular. If you've got GPs that need long-term capital, 3 to 5 years over here to build a better business, to do what they need to do with the underlying companies, and you've got LPs over here that have built, their portfolios in different ways in different markets, and it has reacted differently. What you have is a secondary market in the middle. It's the bridge to be able to allow that ecosystem to persist and to do all the things that private equity needs to do, while the LPs have a capacity to also tactically reallocate their private equity portfolios along the way. I could go on for hours, but the main conclusion of my rant here is that we're just getting started.
Because Yann was mentioning how deployment has been part of this. I think it's also just the amount of deal flow we're seeing in general that's not even getting deployed. So we're seeing in our database, we track everything that comes in and things that we're sourcing, ourselves. And last year it was north of 200 billion, but yet you saw about 160 billion transacted. This year we're seeing well north of the 250 billion that Lisa is mentioning, and not all of it is actually getting transacted because there's just not enough capital to do all of the deals, and people are being very selective about what they're doing. So not all the deals that are hitting the market right now are actually even getting done. So I agree with you. I think this could be a much larger industry if we had more capital. It's a good problem for us as buyers to have, that we're having a lot more selection and ability to pick and choose our deals than what is actually transacting. But yeah, it is something that's constraining the growth.
In years past, Yann, you and I have discussed how painting secondaries with one brush was always nonsensical, and private equity has grown and evolved from buyout to growth equity to getting specialized by check size, not just check size, but industry, niche within the industry. And, we're starting to see that with secondaries as well, right? You mentioned infrastructure, credit, venture capital. So a couple questions on the back of what you said, Yann. One, what are the risks that get introduced to the industry as specialization gets introduced? And second, when will we ever get to the second innings, and what is the second innings?
Okay, well, I think at the place of talking about it, the risks of what happens as the industry kind of matures, I think it's about the opportunity set. So I think the opportunity set is for LPs to have a much diverse set of tools or products for them to put into their portfolios using the secondary market as an example. So what I always say is that there's just different risk returns in all of the different secondary strategies here. If you look at preferred equity versus an LP secondary transaction versus a levered LP secondary transaction, a multi-asset continuation fund, or a single asset continuation fund, it's no better, no worse. It's just different on the risk return spectrum at the end of the day. And so as an LP going into the secondary market that's maturing and is starting to disaggregate, just know what you're looking for and know what the risk return of that strategy is, and then pick the best manager that is going to be able to transact on that particular part of the market. And so I look at it and saying, yeah, you're right. We shouldn't be benchmarking the whole secondary industries as one benchmark. That is, I think, something of the past, and thanks to Nigel and his team and the continuation vehicle kind of benchmarking that he's putting out there, it is starting to disaggregate in the different strategies. I think we were talking about in chapters, right? So maybe like we've entered the third chapter. I think it is kind of like it takes about a decade to go through each one of these kind of iterations of the secondary market, as I've talked about, and we are definitely in the decade of capitalization. We put out a prediction that the secondary market can get to $1 trillion by 2031, and I still believe that is that we can get to that. For me, the question is definitional. What is a secondary? If we start saying, okay, well, a secondaries is single asset, multi-asset continuation funds, LP secondaries, preferred equity, NAV lending to secondaries, if you've got private credit, infrastructure, real estate, if you add all of that and define that as a secondary, venture capital, growth, all of that, can we get to $1 trillion by 2031? The answer for me is, can we get this industry capitalized, and is there enough resources? because those are going to be the constraining factors to this industry, not supply.
Kevin, you had alluded to it earlier that not everything is going to get attention. Some deals are going to die on the vine for lack of capital. So when you think about this disconnect, which segments are best positioned to outperform in your view, and which are the segments that just aren't going to get attention?
Yeah, I think it's interesting. I think this is a time where I think LPs need to kind of think about different buckets. As Yann was saying, these are different categories within secondaries. And I think historically LPs or institutional investors have just viewed them all, okay, here, this is a secondary, okay. But they're very different levels of risk versus a single asset fund versus a highly diversified LP focused secondary fund. And historically, we just haven't had that from institutional investors that are looking at putting money into these different segments. They just have it as one bucket. And I think there has to be that change in thinking. Now, thinking about what's the best position right now for where's there not enough capital going after all the deals. In my mind, what I'm seeing is on the GP-led side, particularly in the mid-market.
Nigel, Kevin alluded to pricing as a determining factor to where attention goes. In the first half of this year, it seems that diversified buyout funds reach 90% of NAV for the average pricing, and that bid-ask spreads continues to narrow. What's your view on the underlying drivers supporting this pricing strength, and what could trigger a reversal or new volatility in secondary pricing for the remainder of the year and going into next year?
I think it's good questions. I think number one is just availability of dry powder. So on one hand, we're saying we have dry powder here, so it's forcing pricing up. However, you have to break dry powder down. And of the sort of 220 billion of dry powder we had at the beginning of the year, probably around 65% of that is directed to LP transactions, more or less. So with the rest of it to GP driven. However, we think the market will be more like 55% LP, 45% GP in terms of market volume. Evercore, I mean, we will execute a minimum of $100 billion of transactions this year. So we have a fairly good window into what's happening. So availability of dry powder. But having said that, dry powder has gone from about 220 billion to around 170 billion in mid-year. So it is going down. It is being used up. I think the second thing is in terms of driving pricing is theoretically there's another 220 billion or so to be raised for secondary strategies over the next year. So if that continues to be raised, then pricing should stay up. And we've talked about 40 Act funds and the impact there, and LP. So all this is in terms of availability of capital. I think also we see after the wonderful Liberation Day here, somewhat stability in public markets. S&P is 15% up year to date. So that momentum in public markets is helpful for pricing. Plus, the somewhat the return to some degree of the IPO market and the M&A market will give confidence to secondary buyers in terms of exits likely to be coming sooner than later. So that will provide confidence. It will provide pricing, and just new market entrants. Sector-specific entrants in private debt, private infrastructure, private real estate, which is all feeding in capital at the right cost of capital. So it will be private debt capital buying private debt assets, as opposed to what used to happen. It was a regular secondary fund bought a private debt instrument at a big discount. That doesn't happen so much anymore. What are the risks? I think the risks are exactly the opposite of that fundraising environment. That if secondary investors go out and facing still a very challenging fundraising environment compared with when a lot of flagship funds were last raised, well, that's likely to mean folks will slow down in terms of deployment, which will likely put downward pressure on pricing. And also, it is early days in the 40 Act funds. Potential regulatory concerns around that part of the market. All this can have an impact. And we're in a very high valuation environment still. So I think there's concerns around that. There's seems to be a lot of sensitivity around interest rate cuts. Adding all that, I think, the risks that we see. Also, I think potentially in terms of pricing is that we see more GPs now willing to sell an asset below their NAV, which I think is new. Particularly 2021 and beginning of 22 deals, where a beginning sense of GPs that say, it's never going to be what we expected. The world has changed. Let's just return capital to the LPs. So we've seen situations recently where, assets are being sold at 1.5 times, below the business plan. And if that was to continue, then that may change the calculus for secondary investors and where exits are supposed to come out, and that will all go to pricing. And I think just the final factor is obviously, black swan events. If we have another, we don't really know what's going to happen with Ukraine. A lot of talk right now on potential solutions, but we really don't know what will happen there. And there's concerns around the AI bubble and things of that nature. So I think how we think, the positives I just mentioned in terms of, capital available in the public markets and new forms of capital, but again, fundraising is going to be a concern, and the valuation environment.
Yeah. And one other thing to add to Nigel's point about why pricing has gone up, I do think it's higher quality as well, and you observe this in the direct private equity market as well. People are saying, how come valuations for the highest quality buyout assets are still in the 15 to 20x, and it's just because it's only the highest quality that are getting sold. And so this year, what you observe, and this is to tie in what Kevin was saying too, you'll see LPs come out with 6 billion, really wanting to move 1 billion or 2 billion, and so the buyers are picking and choosing the highest quality, hence getting to the highest price. So I do think when you look at quality of the funds that we're buying, 15, 20 years ago versus today, they are much higher quality assets, strong revenue growth, decent margins at reasonable valuation. And so then, you do see some compression in discounts because of that as well.
Yeah, you're seeing that play out in some of the numbers too, because a lot of the GPs that used to be able to buy some of these trophy assets, fund to funds, a different private equity fund would sell to another private equity fund. A lot of that's being taken away by these continuation vehicles. So I think about 4 or 5 years ago, it was about 5% of the total transaction volume was in these CVs. Last year it was 14%. This year is probably going to be closer to 20%. And so what you're seeing is a lot of these GPs now moving into the GP-led space and raising their own continuation vehicles, funds, to try to get access to those high quality deals that Lisa was talking about.
I also think that this is a bit of a raise and deploy market. Basically whatever gets raised in that year is what gets deployed at the end of the day. And so in my 25 years of doing this, I haven't seen a market that has been so fluid in terms of pricing as over the past year. There are all of the events that Nigel talked about that are just been like really causing a lot of fluctuations and just even buyers' mindsets around being risk on and risk off. Then on top of that, you've got, the when they're raising the capital, at what pace they're raising the capital. I mean, if you look at this year, and if we do get to the 250 billion that Lisa so ambitiously predicted, I mean, the reality at the end of the day is that you're going into Q4. Most buyers have already deployed the capital that they're looking to deploy for the year. And so if you need to get something closed by the end of the year at this point in time, there's probably a pricing discount that's going to come along that. And so maybe wait for Q1 in order to be able to actually do your transaction where people's buckets have been kind of refilled for the year. So there is a lot going on in the market, but there's also sub-cycles happening even within that. And then you've got sub-cycles within the different strategies of the secondary market. Private credit is not a very deep market. And so if, a few of the big buyers did a transaction and they're out of the market for a quarter, that might impact pricing just for 1 or 2 transactions. Like, it is so fluid right now. There's so many things that are hitting pricing right now. And so, yeah, pricing is holding up on a macro level when we talk about the whole industry, but behind that is a lot of nuances of fluctuations of pricings that are changing on a week-to-week basis. Like, this is a very fluid market.
Yeah, no, apart from the capital being a constraint for the growth of the market, you touched on it a little bit earlier, Yann, about the talent and the availability or the lack of availability of talent. And as secondaries has grown, it's created a shortage of professionals with this hybrid skill set. And as more funds are coming to market, and as more folks are getting specialized in segments, do you feel that the talent gap is equal at all levels, or where do you see the talent gaps between the junior, the mid-level, and the senior level? And how are firms addressing that challenge through recruitment, training, and retention strategies?
No, I think that the reality is that this is an industry that is kind of running really rapidly to try and kind of build the resource pool at the same time as the industry is growing substantially. So there is a gap in resources, I think, not just on the secondary side, but even in just service providers as well, the legal industry and all that sort of stuff. A lot of folks are kind of really trying to build the resources as they go. The reality is that it just takes time sometimes. You can't replace time in terms of building kind of an experience set of professionals within an industry. And so what you've seen more recently is that there's been a lot of musical chairs, certainly around kind of the agents, as people try and find people that have experience to be able to kind of lead these businesses. There hasn't been a lot of people with 10, 15 years of experience in this industry. But that's okay. It will build over time. We are all growing as firms, and with that comes the growth of kind of resources that will enable this industry to continue to grow. But I will say it's not just resources. There is a whole other facet of this, which is the tech-enabled, analysis that is really going to increase the productivity of the buyers in terms of how they diligence underlying portfolios. My sense is that if you haven't leaned into AI or machine learning as a secondary buyer, it's already too late. The reality is that there's just so much productivity gains that can come from this, but it's not something that happens overnight. It takes, a good 3 to 5 years to get the right systems in place, the stack, to get the right models, to get the right productivity. We love to think about AI being revolutionary in terms of an overnight solution. It's not. It takes really a lot of thought in terms of how do you get access to the data, how do you integrate the data, and then how do you extract the data in a very accurate way. And that is a tool that takes time, attention, and intentionality. So you've got resources that are building, and you've got tech enablement that's helping. I think those two will continue to grow with the market. So over time, that resource gap will decline. But yeah, right now, if there was more resource, there would be more deals in this industry. There's no doubt.
And maybe, Lisa, if you can follow on the point about technology. Obviously, BlackRock straddles the line between being an asset manager and a technology firm at times. And as deal complexity rises and secondary participants are increasingly leveraging technology, and AI being one of those tools, and digital workflow tools to streamline processes and enhance transparency, how are you guys investing in technology? And looking ahead, what are the solutions market participants most like to see as far as further transformation in secondary deal execution?
Yep. Well, I guess first, TresVista, Avi, you've been a great partner to us, so we will continue to be using you, just maybe up the higher value chain first and foremost, as we get more access on the data. I also have sort of a 3-phase evolution of secondaries. It's a little bit different than the way Yann described it, but I think about it more as value creation in secondaries. And so if I think about secondaries and how it's evolved versus direct private equity ecosystem, secondaries is probably 3 to 5 years behind that. And so if I follow the same trajectory of value creation for direct private equity, the first phase was leverage and structuring. And so being able to use, credit facilities and fund finance and sort of some of these leverage opportunities to drive value. Second stage is kind of what we talked about a lot already, which is specialization. And so again, on direct private equity, you see people going into healthcare, building out operating resources, becoming more tech, software services. And so obviously secondaries, we're in that phase right now. Where the direct private equity market, I think, has already moved into is also tech-enabled. And so digital transformation. And probably 2 or 3 years ago, you really started hearing about direct private equity firms becoming more tech-enabled services, health tech, fintech, real estate tech. And secondaries right now is really just, in my mind, in the early innings of that technology journey. But that will be one of our value creation tools and one of our operating leverage tools. So at BlackRock, again, framework in terms of technology, I really break into 3 sections. One is data, second is analytics, and then third is sort of predictive models. And so on the first one, data to me is the currency of what drives the phase 2 and 3. So having, building your own proprietary data lake. There are some things, again, obviously with Preqin and at BlackRock, we have eFront as well. And there are things that everybody can access. And then there are things and data sets that are proprietary to a specific organization. And so having, whether it's the primaries program or whether it's the credit, private credit program, or whether it's a co-investment program, every single data point and investment opportunity that an asset manager can have, that is a data point. That is a single data point. And, our objectives within data is, how do you get faster access to data? So minimizing the time between when reports come out to when you actually get access. How do you get deeper data? So not just focused on fund and NAV and TBPI and DPI, but what about the operating metrics behind it? Right now, it's just kind of financial metrics, revenues, EBITDA, but eventually you can come into operating. And then the breadth of data. So again, a lot of organizations have access to data of things they're invested in. What about all the deals that we passed on, the 99.5% of deals that we passed on? How are we capturing and making sure that data set still sits in our data lake? And then moving into analytics, I almost think about like as the old school library. When you go into the library and you open up like the drawer and then you start looking at, trying to find your book, and it's so we need a way to be able to all the data, all the different types of data that feeds into our ecosystem. We need a way to be able to build analytics around just to analyze it. And the analyzation of that data really helps us with comparability. So think about like benchmarking, standardization, being able to kind of compare one portfolio to another very quickly, and then eventually offer transparency to what the returns might be, but also what the risk might be. And then lastly is this model, is just a forward-looking analytics, which is about what are the predictive abilities, what are potential return outcomes, but also more importantly, what are the volatility of those returns, which again gives a sense of the risk, the return over risk. And then AI is really a foundation across all 3 of them. And being able to, again, when we think about using AI and data, it's about how do we use AI tools to extract data better. Okay, in the analytics portion, it's how do we use AI tools to build sort of standardized models so I can pull all this disparate data into something that is easy for an investment committee member like myself to review. And then lastly, I think the third phase, it's more of a vision, but it's like how can we use AI to actually produce alternative data, not just data that we have access to, but like alternative data, so that there is actually a feedback loop and have the ability to train itself and also to build predictive models on its own. So again, that's a little bit more harder to think about, but I think if we can we're working on the first one, we're working on the second one, and every single quarter, we're sort of working very closely with our, data and analytic teams. I think half of the BlackRock organization sort of is in our data and tech org. We're trying to, build those bridges so we can sort of build those pipes, and that way, when we sort of connect all the private market data and then now the public market data, we can quickly be able to hit all 3 of those pillars of our tech vision.
I think everybody in the secondary space is kind of on their different path of technological transformation and trying to figure out how best to use technology. But I think it comes back to your question around talent and how do you most effectively utilize the talent you do have, and it's by making them more efficient. I mean, we can certainly add more bodies and bring in people from other industries, from the direct side or from investment banks, and try to add to the overall power of resources just from that perspective. But I think technology is going to be the way to really be able to drive our ability to really leverage the resources we do have to be able to increase the transaction volume that we can work on and transact on every year.
I got to say that rarely a day goes by without me feeling grateful we're in this part of the market, because I genuinely believe the secondary part of the ecosystem that we're in, the part of the private market, is by far the most exciting, the most innovative, the most fast moving part of this market. And, I think we're all pretty grateful to be in it. And I think when we talk about human resources and our team, the reality is the number of transactions going on, the people can't keep up. And so we barely have enough time to train anybody. So I think that the talent gap is real in this industry, and everyone in it is benefiting from it. So, I think that it's a great place to be, that we could be in, a lot of places where we would be, just be looking at the clock, getting ready to go home. But we're kind of fortunate. We're definitely at the cutting edge of this business. And
there's a saying, necessity is the mother of invention, and you use the word innovation, Nigel, and there's a lot of necessity that drives the behavior in the secondary market, right? The huge opportunities that nobody wants to turn down opportunities, but how do you take advantage of that with your structures, with your team? And the interesting thing I think about technology is it can create a competitive advantage, but for a very short window of time, right? Especially with a tool like AI, it's cost effective and it's ubiquitous, right? It's just how quickly will you adopt it, and it can give you an advantage for a very short window, but everyone's going to catch up. And obviously what TresVista is doing, sitting in the middle of this ecosystem, and we're investing very heavily in technology as part of our service offering for our clients. Our clients are demanding more of us. Half of you here have now hired TresVista people into your teams as part of your talent strategy, as opposed to just having a relationship with us, which is fantastic. As I think about invention, Kevin, what are some of the innovations you are seeing? What is this necessity driving in terms of innovation and invention in your business?
Yeah, I think we touched on it a little bit with the innovation around using AI, and in terms of being able to screen portfolios, in terms of being able to take data from memos and make it easier for investment committee members to be able to quickly find the key criteria for what we want to look for in secondary transactions. I think it's interesting that the limited capital that we're seeing is really what's been constraining the growth of this space. But it does somewhat constrain the level of innovation here as well, because when you see a lot of capital flowing into the secondary space, and maybe a limited amount of deal flow, that's when secondary firms get more innovative and creative about how to deploy the capital. And so I think about the mid 2010s. I think we saw a lot more prep deals come to the market at that point in time, because we saw a lot of the LP deal flow dry up a bit, especially the ones with larger discounts. And so I think secondary firms were looking for ways to creatively find lower risk but higher returning transactions. We saw a lot more prep deals come to the market then. I think Yann took advantage of that and certainly built up Dawson from that trend. But we've seen the same thing in terms of as private credit secondaries started really 2018, 2019. I think that flowed from again, more capital being available to pursue these different strategies. We're seeing it with infrastructure, we're seeing it with real estate a bit. And so I think having more capital flow into the market is going to be important for driving that innovation and continuing to find ways to kind of cut up the secondary market into different risk premium segments. And so I think that's where it's interesting. If we can continue to grow this market and be able to find that capital, I think that's what's going to drive the continued innovation in this space.
So if I go back to the chapters of the secondary market, if you think about it, 2011 to 2021 was a decade of innovation. The industry almost out-innovated itself in terms of the amount of deals that they could do. Started in 2021, the industry started innovating in terms of how they capitalize their business. to a certain extent. And so while most of that capital had been raised from institution and continues to be, in the secondary market, what you saw was the opening up of the open-ended funds and the opening up of the CFO opportunities. And so I think that that's what's really interesting, is that the secondary market now, has innovated in terms of how they deploy to a point where they're, undercapitalized. Now they're innovating in terms of how they're raising capital in order to meet that capitalization. And so, to Kevin's point, innovation tends to peak when there is probably more capital available, because there's less capital available to deploy right now. It's an undercapitalized market. There's less innovation that needs to happen, and the innovation has to happen in the capitalization. I don't know if that made sense, but it's an interesting kind of almost hourglass reference as to what's happening in the secondary market. I think the innovation is happening in terms of how this industry is getting capitalized, rather than how the capital is getting deployed over the last little while, and will continue over the next 3 to 5 years.
So thinking about the future now, 3 to 5 years from this, maybe we can go to 2031. Yann, you predicted $1 trillion transaction value by 2031. All right, maybe I'll ask each of you to give me your market size projection for 5 years out, and then maybe one, eyebrow raising perspective that we can revisit 5 years from now.
Well, on the size, I kind of agree with Yann. I don't know why you use 2031. 2030 seems like a nicer monarch, but fine, I'll take 2031. 1 trillion, I can definitely see a path there. I don't know if this is eyebrow raising, but I did sort of reflect on that when Yann was talking about being more innovative on the capital raising. I think ultimately managers have to. It's a business strategy decision. Are you a beta play? Are you a beta plus? Are you alpha? And depending on maybe which risk spectrum you want to go towards, which is related to the capital raising point, what type of investors want each of those, and how do they want to deliver? How do we as a manager deliver that to the ultimate customers, which are clients? That will determine a little bit of areas of focus. And I guess if there was a eyebrow raising point, I sometimes think that the emergence of the GP led, LP led innovation, it sort of is there's a debate about, is it caused by the LPs requesting distributions, or is it caused by GPs being too creative? Is it caused by the secondary buyers coming up with this innovation solution? And I think everybody sort of is either at fault for that, or actually leading to why this innovation continues to happen in terms of kind of who is the actual buyers and the users of the products that we've been developing and building. So that was what I was thinking when Yann started talking about the innovation of capital.
Yeah, I'm probably going to be a little bit. I have a different view, I guess, in terms of where we think this market can go. I think that's $1 trillion is aggressive. I think we're probably in 2030, 2031, probably going to be somewhere in the 500 to maybe $600 billion of transaction volume. I continue to think that being able to raise capital is going to be what leads this to be constrained, and the talent that we've talked about. So I think you have to have a little bit more measured growth over the next few years, unless something changes significantly around the DC space. So if something happens there where it opens up that capital, then I think Lisa and Yann could be right. This could be $1 trillion industry, because that would just unlock all the 401ks that are out there to come in. And I think if there's any product that makes the most sense in the private equity space, it's secondaries, because of the diversification that it brings in terms of secondaries. So that, if that does get unlocked, I think that's where you change things, and could be a whole different ball game for the secondary industry.
I was thinking, so my $1 trillion persists. I think I do have confidence that we can get there. I think there is an opening up of capitalization that is happening right now, and I do believe it's definitional. So I don't know if you're in your trillion or 500 to 600, you're talking about NAV lending for secondary funds as an example. Like, it's all definitional. GP stakes, is that in the categorization of a secondary? at the end of the day. I think my eye-raising one, I was thinking about this as others was talking, is I think that there could be an open-ended fund that has over $100 billion of AUM, of which a majority of that is focused on secondary. And as I was thinking about 100 billion, I was like, is that even enough? Because if we're talking about kind of 5 years from now and the pace at which the open-ended funds could be raising capital over the next little while through private wealth, maybe you've got an open-ended fund that has 150 to 200 billion dollars of AUM that is mostly focused on the secondary market.
I think in terms of volume, I think it will be somewhere between 500 billion and a trillion. So I'll give myself a wide range there. And I think that what's going to drive that is the adoption by wealth management, the growth of sovereign wealth funds, insurance affiliated vehicles and the like. But I think the key change that will trigger volume is electronic execution. And I think if we get to electronic execution, where there's a real clearinghouse for private assets where individuals can transact with visibility, I think volumes truly take off at that point, because a lot of the friction will have been taken out of the system. Whether that's 2031, I don't know. But I think when that happens, history tells us when you get electronic execution and standard documentation, volumes take off. We don't have either of those two in the secondary markets yet, but when we do, things will be very different.
Have given me the idea of what we got to be focusing on working with you. So we've got to create a clearinghouse and make electronic execution possible sooner rather than later. So
Let's do
I
it.
want to make sure Yann's prophecy comes true. And I'm sure next year we'll have this conversation and say it's another record year. And so I'm looking forward to that conversation. But thank you all for taking the time to speak today. It's been very enlightening.